Hello and welcome to today's video, Mastering Accounting Basics, a comprehensive guide for beginners. In this video, we dive into the basics of accounting. We will only be touching the surface, but you should still get a good introduction to accounting. We will cover the essential principles and practices that form the backbone of accounting. So let's get into it. Accounting is the language of business, as we discussed in another video. It's the process of recording, classifying, summarizing, and reporting financial transactions of an individual or organization. Accounting provides a clear picture of financial health and performance and helps stakeholders to make informed decisions. Whether you're running a small business, managing personal finances, or pursuing a career in finance, understanding accounting basics is crucial. Now let's look at some key accounting concepts. The first one is assets. What are assets? Well, assets are resources owned by a company and have economic value to the company. Examples include cash, buildings, inventory, equipment, and accounts receivable, which is money owed to the company by its customers. The next concept is the opposite of assets, and that's liabilities. Liabilities are the company's financial obligations or debts, or things that the company owes. Examples include loans, accounts payable, which is money the company owes to suppliers, and which you can think of as the opposite of accounts receivable. Taxes payable is another liability, and also wages that's owed to employees. The third concept is equity. Equity represents the owner's stake in the company, and is calculated as assets minus liabilities. The fourth concept is revenue. Revenue is the income generated from business operations. Examples include revenue from selling products or providing a service. Interest income is another source of revenue. Revenue from selling goods or services is called operating revenue. So what's the difference between operating and non-operating revenue? Operating revenue is derived from a company's core operations, while non-operating revenue is derived from activities unrelated to a business's core operations. Interest income, for example, is generally not considered operating income unless you are running a bank or other financial institution whose main business is lending money to earn interest. If you're operating a restaurant, for example, and you earn interest from money deposited at the bank, that interest income is non-operating revenue because restaurants are not in the business of lending money. The last concept we look at is expenses. Expenses are the costs incurred in generating revenue. Examples include rent, salaries, utilities, and advertising costs. Those are some of the core concepts in accounting. Now let's talk about something that's very important in accounting, the accounting equation. The foundation of accounting is what is called the accounting equation, and that equation is assets equal liabilities plus equity. So let me repeat and emphasize that. Assets equal liabilities plus equity. That's the accounting equation. This is the foundation on which all accounting is built, and the equation must always be in balance. If it is not in balance, you know that something is wrong with your accounting. Every transaction affects at least two parts of the accounting equation. When you buy inventory with cash, assets change. Cash decreases and your inventory increases, but the total assets remain the same and the equation remains in balance. When you take a loan, both assets, cash, and liabilities, the loan increase. Once again, the equation balances because the two sides of the equation changes by the same amount. Another core principle in accounting is what is called double entry bookkeeping. Double entry is a system used in accounting where every transaction affects at least two accounts. Each transaction has a debit entry, which is the left side of the ledger, and a credit entry, which is the right side of the ledger. A ledger is a record of all financial transactions of a business. There are different types of accounting ledgers. and we'll discuss that in a future video. The total debits must always equal the total credits, ensuring the accounting equation stays in balance and the ledgers are balanced. If the ledgers are not balanced, the financial statements will not be correct. And by the way, what are financial statements? Well, financial statements show a company's financial performance and business activities. Properly prepared financial statements will tell you where a company's money came from, where it went, and where it is currently. There are 4 main financial statements, and not 3 as many people think. They are the balance sheet, which shows the company's assets, liabilities, and shareholders' equity at a specific point in time. Assets are listed on the left or top of the balance sheet, while liabilities and equity are listed on the right or the bottom, depending on the format of the balance sheet. The total of assets must equal the total of liabilities and equity. So the balance sheet, as the name suggests, must always be balanced. The balance sheet is a financial statement that best demonstrates the accounting equation, which, as I mentioned earlier, is assets equal liabilities plus equity. The second financial statement is the income statement or profit and loss statement, as it is sometimes called. This shows the company's financial performance over a period of time. It starts with revenue, expenses are then subtracted, which leaves net income or net profit or net loss if expenses are more than revenue. The third statement is the cash flow statement. The cash flow statement shows how changes in balance sheet accounts and income affect cash. It's the amount of cash that flows into or out of a business over a specific period of time. The cash flow statement is divided into 3 parts: operating activities, investing activities, and financing activities. The fourth and final statement is a statement of changes in equity. It is often lumped with the income statement, but is its own financial statement. This statement measures changes in shareholders' equity over a specific period. Those were the 4 financial statements, and in future video we will go a little deeper into each of these financial statements and explain the different components. Now we'll continue by looking at types of accounting. There are 2 main types of accounting: financial accounting and managerial accounting. Financial accounting focuses on preparing financial statements for external users based on generally accepted accounting principles, which are used in the US, or International Financial Reporting Standards, or IFRS, used in most other countries. The second type of accounting is managerial accounting. Managerial accounting provides internal stakeholders with financial information for decision making, planning, and control purposes. Now let's take a look at accounting principles. There are certain principles that govern accounting and make it all work. First, we look at accrual basis versus cash basis accounting. Accrual basis. So under accrual basis accounting, revenues and expenses are recorded when they are earned or incurred, regardless of when the actual cash is received in the business. If, for example, a company sells products on credit but won't receive payment until 30 days, it records the revenue when it makes a sale, although it has not yet received the cash. In this case, the company will pass an entry to debit receivables and credit sales for the amount it has sold. Receivables is an asset on the balance sheet that it will collect after the 30 days, while revenue will be reflected in the income statement at the time of the transaction. When cash is received after the 30 days, the company will debit its bank account for the cash and credit receivables, which will cancel out the debit balance on the receivables account that was recorded when the sales were made. So the receivables will then get to a zero balance, assuming no other entries. Cash basis. Under cash basis accounting, revenues and expenses are recorded only when cash is received or paid. In the previous example, if cash basis was being used, no entries would be done when the sale was made. Entries would be done only when payment is received after 30 days. That entry would be to debit the bank and credit revenue. No receivables account is used in cash basis accounting. Another principle in accounting is what is called the matching principle. The matching principles say that expenses should be recognized in the same period as the revenues they help generate, ensuring accurate net income measurement. The consistency principle. The consistency principle says that accounting methods used should be consistent from one period to the next, which allows for better comparison in financial results over different periods. The materiality principle. The materiality principle says that you should only disclose information that would impact users' decisions. Whether a financial statement amount is material or not depends on its size and impact relative to the financial statements as a whole. For example, if you had $100 million in revenue in your company, $10 would not be material to that $100 million. But if you're talking about $10-20 million, then that would be considered material to the financial statements. The chart of accounts is an organized list of all accounts used by a company. Each account is assigned a unique number for easy identification and categorization. A chart of account may have the following components: asset accounts with numbers 101 to 199, liability accounts with numbers from 201 to 299, equity accounts with numbers from 301 to 399, revenue accounts with numbers from 401 to 499, and expense accounts with account numbers from 501 to 599. That's an example of how you could set up your chart of accounts. Of course, you can always use different account names and different account numbering systems. Next, we talk about another basic principle of accounting: debits and credits. This is a cornerstone of accounting. Understanding debits and credits is crucial in double entry bookkeeping. Debits and credits tell whether an account will be increased or decreased for a particular entry. Accounts are increased or decreased for debits and credits as follows. For assets and expense accounts, a debit would increase the balance while a credit decreases the balance. For liability, equity, and revenue accounts, debit decreases the balance while credit increases the balance. Very important to remember those. Remember, the total debits must always equal the total credits in any accounting transaction. That's very important. Okay, let's talk about the accounting cycle. The accounting cycle is the process accountants follow to record transactions and create financial statements for a specific period of time. Steps in the accounting cycle may vary, but a typical cycle may be as follows. 1. Identify the transactions. 2. Record the transactions in a journal. 3. Post the transactions from the journal to the ledger. 4. Prepare an unadjusted trial balance. 5. Make adjusting entries. 6. Prepare an adjusted trial balance. 7. Prepare the financial statements. And 8. Close the temporary accounts. Now, all of this might not mean much to you right now, but as we continue with this channel and post new videos, we'll dive deeper into all of these topics we're bringing up now in the future, so you'll get a better understanding. But for now, we're just giving you the introduction to these so you can know that these things exist and how the process might work. So to continue, let's talk about accounting standards and ethics. Accountants follow what is called Generally Accepted Accounting Principles, or GAAP, in the US, or International Financial Reporting Standards, or IFRS, as in most other countries in the world. Now, these standards provide guidance for consistency in reporting, full disclosure of financial information, materiality, that is focusing on significant items, and conservatism when making accounting estimates. Okay, let's look at ethics in accounting. Ethics is important. Accountants work in a position of trust and must maintain high ethical standards. Accountants must 1. Maintain integrity and objectivity. 2. Avoid conflicts of interest. 3. Protect client confidentiality. And 4. Comply with relevant laws and regulations. Now, back in the days before technology was advanced, accounting was all done in big books called ledgers, where Accountants would write down pretty much all transactions in the ledger. And you can imagine how difficult this must have been when a mistake was made and you had to try to find an error. That would have been a nightmare. Now, in today's world, we have accounting software, which makes the accounting job way much easier than back in the days when they used paper books and pens and pencils. While it's not necessarily for understanding the accounting principles, familiarity with accounting software can be helpful. Popular accounting software for beginners include 1. QuickBooks, 2. Xero, and 3. Wave, which has some free features. And there are many more accounting software out there. This is just touching the surface. Accounting software can automate many accounting tasks, but understanding the underlying accounting principles is important to maintaining proper financial records and to interpreting the financial statements. Accounting might seem daunting at first, but with practice, these concepts that we just talked about will become second nature. Remember, good accounting practices are essential for making informed business decisions, securing financing, and complying with tax laws. We will tackle more complex accounting topics in future videos. We'll cover topics like depreciation, revenue recognition, financial statement, and ratio analysis, just to name a few. But we'll be touching the whole breadth and depth of accounting. This brings me to the end of this video. I hope you gained a better understanding of financial statements from watching the video. As always, please remember to leave your comments in the chat and like and subscribe to the video. Also, let me know which topics you would like to see us cover in the future. See you in the next video.